All right, good afternoon. We're going to get started with the next section of the program. If we can have everyone take their seats and turn their attention to the center of the stage for our next speaker. I'll give everyone just a minute or two to close up their conversations and get focused for the next session. You guys are great at listening to instructions. I can tell I'm in a room of lawyers. And you guys are all dressed in suits, not hoodies, so I'm glad you guys got the memo. You're in Washington, D.C., not Silicon Valley, which is fine. Okay, I see a few rebels in there holding it down. We've got the honey badger over here. Well, good afternoon. My name's Perry Ann Boring, and I'm the founder and president of the Chamber of Digital Commerce. We are the world's first and largest blockchain trade association. Over the past several years, we have built such a strong partnership with Georgetown University. Congratulations, Chris, on such a strong program, great speakers, great content. Really shows the level of leadership and expertise that we have here at Georgetown. The Chamber of Digital Commerce, we're a proud sponsor of Georgetown's Fintech Week. We're also the host of the DC Blockchain Summit. We'll be holding the 4th annual Blockchain Summit the first week of March at the McDonough School of Business. This past year, I also had the honor of joining the Georgetown faculty as an adjunct professor, and I teach the school's first Fintech and blockchain course. And today, I have the pleasure of introducing an important public sector servant who has made just huge strides in really leading the conversation for the Fintech sector in the United States of America. Craig Phillips, he joined the U.S. Department of Treasury in January of 2017. He serves as counselor to Secretary Mnuchin. He assists the Secretary in a range of matters, including domestic finance, domestic financial institution policy, housing finance policy, and regulatory reform. Mr. Phillips brings a wealth of experience from the private sector to the Department of Treasury. He previously worked at BlackRock, Morgan Stanley, and Credit Suisse First Boston, and he holds a BA in Economics and Business Administration from Vanderbilt University. As counselor to Treasury Secretary Mnuchin, Mr. Phillips plays an instrumental role in the U.S. government. He is truly at the center of the administration's consideration for modernizing the financial system and was the key architect in their FinTech report. This report, for really the first time, publicly acknowledged in an official statement of the U.S. government the need to create policies to promote the development of FinTech solutions. However, this report did not specifically address blockchain, something, of course, I'm very passionate about. Many of the policies in that report will impact the blockchain sector, most notably promoting regulatory harmonization across the states for money transmitters, such as through a program of passporting. Also, the concept of regulatory sandboxes. These types of regulatory innovations have been now recognized worldwide. We're truly proud to see the United States recognizing these important principles for our economy here in the United States of America. And Mr. Phillips, thank you very much for your leadership on behalf of the FinTech sector. We're very lucky to have you as a servant here working in the Secretary of the Treasury. Everyone, please help me join in welcoming Mr. Craig Phillips.
Thank you. Well, thanks for being here. If you'd done FinTech Week last week, you would have had better weather. Hopefully it improves as you're here. But I really appreciate everyone taking an interest in public policy. I've really loved what I've done at the Treasury. And for this industry, FinTech in particular, I know today is more about crypto. It's really critical that you get in the mindset of public policy to pursue your dreams, whatever those dreams might be as you think about this sector. I'm going to really cover 3 areas. I'm going to try to do it in kind of plain English and not get too technical. One is just give a general overview of our approach to financial regulation. The Trump administration has laid out a very clear path of philosophy on regulation. And on the biggest picture, it pertains to the whole financial system. The second is, in particular, zoning in a little more on the concept of innovation, the importance of innovation and the implication for fintech. And finally, I'll update you on our kind of thought process around digital assets and the work we're doing at FSOC, which is the Financial Stability Oversight Council. That's a body that the Secretary convenes and chairs, but is comprised of all the independent regulators, including 3 state members as non-voting members. So just to give you some orientation, the President in February of last year put out an Executive Order 13772, which laid out core principles for financial regulation. So this was kind of a North Star guiding light of what our view of regulations should be. And our ask was to look at the system, the way that current statutes, regulation, guidance operates, and identify places where those aren't consistent with the core principles. So these core principles are things such as protecting taxpayers, making consumers have more choices to plan for their financial future, assuring that our institutions are competitive globally, to making sure that regulators are accountable, efficient, and effective. So it was a basket of about 8 items that were the core principles. And so it was a huge task to look at the entire financial system through this prism. So we have 4 reports that are out. We decided to break into 4 pieces because the financial system is so vast. And those 4 pieces were banks and credit unions, which is our first report out in last June. Capital markets, which deals with the structure of markets, fixed income, equity, commodity, derivative markets, but also many aspects of investment products in those markets. Asset management and insurance, and the last one being non-bank financials, fintech, and innovation. That title was derived by shortening a title that was longer, but the other title wouldn't fit on the binder of the cover, and we wanted them to all be the same. So each one of these reports are available online. There's some hard copy. And we're really proud. I'm very proud of the team having put this out. And many say that one of the real values of the reports is that it covers the entire financial system, and one could debate what our policies are, but it really defines the issues. And I found almost uniform consensus that the topics we've identified for discussion are worth talking about. You can have different opinions on the recommendations, but there's real consensus that the financial system and managing it correctly is of ultimate importance to the economy. So really, the work produced recommendations, hundreds of them. They cover 2 categories of changes. One is changes to law or statute. The other is changes to regulation. So in the case of regulation, a regulator can actually adopt new rules. In the case of statute, we need Congress to pass a law or change a law. That's a little harder. So I'd say about 1/3 of the recommendations, on average, maybe 25% require a statute change. 2/3 or 75%, depending on the section, can be done by regulation. So we now work closely with the Hill, but with independent regulators on these ideas. One of the huge problems in the legal system, and I suspect it'll be a problem for fintech and ultimately cryptocurrency and digital assets, is the overlap of regulators. So we really sort of identify the nature of this overlap, the fragmentation of our system, and the duplication. And so a lot of the recommendations are simply if regulated entities could only do something once, you would still have the same regulation, but you would eliminate this duplication and overlap. And in this arena, that I think is a challenge. And lastly, we do think that working on the value of regulation to improve credit flows to the economy, supporting the economy is a valid goal. Some would say that's not a goal, that the cost of failure or downside is not worth measuring in economic results. But at the end of the day, the economic system is there to serve the economy and to serve customers, consumers, businesses, others. So really, we did look at the ease of getting credit, the pricing of services, and an excess of regulatory burden just adds cost to the system. So updates on this are that we've now appointed almost all the regulatory leaders. So we're now working with a slate of new regulators where I think an important tone at the top has changed, and there's large alignment with many of these principles, with a tremendous number of rulemakings in motion, from the Volcker rule to advance notice of rulemaking on the Community Reinvestment Act. to a series of initiatives at the SEC and the CFTC on market structure and market making. And largely, all of them preserve kind of the concept of Dodd-Frank and some of the advantages, but properly tailors them or applies them based on the size or complexity of the business model. The coordination of the regulatory agenda across the agencies is a very high priority. I spend a lot of time on that. And FSOC, where I'll talk in a few minutes about how we're thinking about digital assets, is a very valuable convening authority for the Secretary. On terms of bipartisan agreement, I'd say what's interesting is a lot of the technology and new developments have greater potential for bipartisan agreement. One, they're new, so people aren't as solidified in certain positions. And two, most people agree that they're important. So generally, digitization of finance and innovation is something that has a lot of appeal on both sides of the aisle. Cybersecurity is another area where people feel it's of extreme importance for us to get this right in terms of statute. And there's another bill pending. We passed Senate Bill 2155, which was a comprehensive bill, really mainly impacting community banks and regional banks. There's another bill that's passed in the House, a Jobs Act 2.0, for lack of another name, and it involves a lot of bills that had bipartisan support in the House over almost a decade and relate to capital markets, capital flows, and other features, many of which could impact fintech. So we're really confident that building on the success of the legislative change in 2155, that we have another piece of legislation that can move, and together with the regulators, will create a better tailored, more efficient regulatory system. So with that backdrop of kind of philosophy, I'll point to non-bank financials, fintech, and innovation. And really the key theme of this report was that as we'd done the other reports, we hadn't really focused on innovation. And we came to find that a lot of business had left the regulated sector for the unregulated sector for a lot of reasons: profitability, regulatory burden, and other factors. So it was important to look at it. It also became clear that we needed a more agile and effective form of regulation for the 21st century. There were many elements of historic regulation that just no longer describe the technological reality that all consumers and businesses live in, and also the potential for data and technology. So modernizing an approach to regulation was really critical. And the other thing we saw that we needed to really promote innovation. So I think the message of this report is really that innovation is important. It's critical for U.S. competitiveness. And if we don't get that right, there's a substantial threat. Also, behaviors has changed. So people demand instant access to information, how they search for services. Even the notion of going into a physical branch is an anathema to certain people, particularly a new generation. So modernizing this is going to be quite critical to appeal to consumers. And obviously, people that take these new approaches have shown that they can scale very quickly, in some cases, simply due to their approach of how they think about their customers. So the findings in general were that we advocated for better use of consumer data using competitive technologies. Obviously, protecting consumers is an important part of that, but really the digitization of finance, fundamentally the use of data, is at the backbone of most of these ideas. And that gets into enabling the use of cloud technology, artificial intelligence, and other computing techniques. Secondly, the regulatory framework has to get better in line to encourage regulation. We have a sort of a fragmented system as I began. It's something we need to live with because our system is fragmented. That'd be very hard to change by statute, but we can't sort of move that forward to the fintech and technology without holding it back. We identified almost 85 pages of activity-based regulations that require modernization. These are things that really just developed in another era and have need for improvement to accommodate the flow of data, communication techniques, new modeling techniques. And finally, we have to have an environment that enables experimentation. This has been referred to as regulatory sandboxes, which is not probably an ideal term, but the concept is that if you have a regulated entity that's regulated by multiple regulators, to really truly launch a new innovation, you have to get all of those regulators to agree that some level of experimentation is okay. I really sort of see there's three levels of that. One is the concept of having a new idea. The second is enabling sort of the adoption of that idea through some trial basis. And the third is adopting it as a rule or a permissioned activity that not just that entity, that other similar entities can use. So that's a lot of steps there to successfully implement. Around the world, some countries have done this perhaps more effectively than the U.S. However, some of the countries that come to mind, like Singapore, have very few similarities to the U.S. in terms of scale, size of the country, size of the complexity of the financial system. So the U.S. has to come up with a U.S.-style solution for this problem, and we strongly advocate for it. We're very supportive of the OCC's Special Purpose National Bank Charter. We don't think it displaces state regulators, but we do think that some entities that operate on a national basis should have the ability of having a federal framework. And it is difficult, in spite of all the regulators' efforts at coordination, of seeing how 50 or more examinations can be coordinated. So by definition, a fragmented approach that involves multiple examinations and oversight raises the question, can you really have a true enhanced prudential standard for an entity, which is slightly distinct from sort of how that entity might be interacting with customers within a particular state. So we really hope the states and the OCC can see their way past their differences that exist now, and we're very, very supportive of the Special Purpose Charter. We also are really supportive, and you'll probably hear about it from people this week, of the launch of these innovation offices at federal banking and market regulator. Regulators and regulation aren't very modern. So if you're in a high-tech business and you're in rapid change, you don't think of that as being the characteristic of a regulator. And in fact, people at regulators are frequently improperly trained in technology. We don't have access to the technology that the people that are being regulated have. We don't have the budget. Procurement procedures are cumbersome. So we made quite a few comments about the importance of sort of seeding innovation offices and trying to sort of keep up really with the pace of change. If nothing else, that pace of change is very important, and the regulators hopefully can not be a significant gating issue. Some things that come to mind are really how Fintech interacts with banks and other financial institutions. So we made a lot of observations about vendor management or procurement, how you can partner with a Fintech. One of the ways of incubating innovation is for banks to really have white label services or contract relationship with these vendors, but that can be complicated by the procurement and investment rules. So we really advocate for changes to those, and even ownership and partnership parameters should be revisited. In some cases, that would require looking at the Bank Holding Company Act. Marketplace lending, we think, is a powerful trend that improves costs, access to credit. We recommended legislative codification of the valid when made and the role of the true lender. There is actually a reasonable amount of bipartisan support for that. There's also a reasonable amount of bipartisan opposition, and for different reasons. A lot of different nuances of why people are for or against that. And I think that really, if there was a true understanding of the objectives of these lending platforms and sort of the necessity of having a solid capital market framework of lending integrity, that this can be addressed. But across the board on the activity base, we came up with a series of things where modernization is critical. In the mortgage lending space, things like e-notes, e-signatures, e-notarizations, and electronic mortgage registry. To give you an example of an asymmetry, this is obviously now a possibility, as you know from the technology sense. It's allowed and enabled in many cases. The primary lender to small banks against mortgage collateral is the home loan bank system, but yet as a regulator, it's not yet approved the use of e-notes as collateral. So even though a community bank could start originating an e-note, if their lender, the Federal Home Loan Bank, won't take it as collateral, that would be a problem. So we worked closely with the home loan banks. They have a gathering. They have this as a high priority to address. So a lot of these things aren't sort of intent to not innovate, but they're just legacy procedures, and in some ways the industry has moved quicker than the adoption at the regulatory level. But other areas I'd put out is IRS income verification and modernizing that. In general, modernizing data aggregation and the rules around data aggregation, including consumer protection. How you launch new credit models and other use of intelligence to make better credit and decisions and quicker debt credit decisions. And obviously there's a wealth of potential in wealth management and digital financial planning. So if you look at our report, it's a sort of a menu of sort of activity-based rules that are historically grounded. Some relate to the Telephone Consumer Protection Act. There's many others. And so we've just diagnosed some places where between statute or regulation, we could really accelerate the pace of innovation, both at fintechs and within banks, insurance companies, and others. So I'll just turn to the last topic, which is digital assets and blockchain. I'd say overall, we think the technology has very broad and positive implications. So first and foremost, independent of digital assets and cryptocurrencies, whatever you might choose to call them, there's a lot of potential there. In our other report, we identified a lot of potential in other technology developments, such as the value of the cloud computing, artificial intelligence. And these are all important developments that we need to get right in the U.S. for economic leadership. But also there's a competitive threat. Other countries have advantages in cost of labor, cost of power, other factors. So we could find ourselves in a case where even if something takes off, it's ultimately the jobs are offshored. So it's really important that we get this right for the American workforce in addition to the productivity of our economy. So it might happen, but if we don't take the right approach, it might not happen here. So Secretary Mnuchin in the fall of 2017 decided to start a review of digital assets on an interagency basis. This led to the FSOC working group that I'll describe to you. He had really two concerns that really led to this work. One was the rapidly rising valuation combined with the proliferation of new coins and tokens. There obviously was an incredible increase in the valuation of 2 or 3 of the leading currencies. This led to the adoption and launch of a lot of other products, if you could call them that. And there was a bubble-like mentality in the speculative frenzy in that gave him great concern. At the same time, he had an existing concern working with our TFI, FinCEN, and OFAC about the role of digital assets in illicit activities. Increasingly, digital assets were being found at every crime scene. It was obviously a way of moving value outside the traditional system. There were a lack of established principles that were sort of governing that, particularly overseas. So he viewed the combination of those two factors as troubling and really led to really starting this task force. There were other factors, though, that I think are worth noting. One is we really believe in a coordination among our federal and state regulators, so the convening authority of FSOC was valuable to get us all talking about this together. It seemed there were already some first moves that were somewhat fragmented, and we wanted to have kind of a unified view and ultimately an administration policy. We also have to interact with international bodies in a coordinated fashion. And all around the world, there was a pop-up of sort of reaction to cryptocurrency, the creation of blockchain, and we wanted to make sure that we created a U.S. view before we started interacting with the international parties. Now, one thing I think that's been very successful is that the initial focus internationally was what I would call financial stability concern. So one thing that arose from the financial crisis were a lot of people that work on financial stability. Things like the Financial Stability Board, which is an international organization, it's their exclusive purpose. And they have staffs, but they also set an agenda across the world and with other members. The G7, the G20, other groups gather and meet. The IMF has group meetings. And so I think one thing that's happened positively is that we have gotten away from thinking this as a financial stability concern and more just an important area to focus on for good regulation and sound management of economies. I think primarily the devaluation of the currencies has aided that. It decreases the systemic risk because of the size of the markets. It's debatable whether it would have been a systemic risk even at the peak of the valuation. So I think we've really moved to sort of a exercise where we want to have a U.S. point of view. We want to interact with international regulators with that point of view in mind. And that was a second reason to convene. And the third was he deeply believed in technology. He served as the lead technology officer at Goldman Sachs when he was in the private sector. He's quite a fan of gadgets and innovations and messing around with new ideas, very, very creative on that front. So he really thought the blockchain innovation was really interesting and valuable, and he was concerned that if the digital asset market was not adequately managed, that some of the potential of that could be lost or squandered. So really market structure is another area of concern where, if something grows, you have to really decide as an asset class, how do you create viable and transparent markets? We really aren't for deregulation for deregulation's sake. We want the flow of capital to be efficient, effective, and have solid, transparent leading markets. So really the nature of making prices, liquidity, and the fact that traditional intermediaries aren't involved in the digital market was somewhat confounding. So really getting the regulators to focus on this as a new area with potential, but living outside the traditional system was another outcome of getting together. And it was quite obvious when we first convened that most did not know much about it, and it is an area that is rather hard to research. It's not, some of the sources of information are somewhat traditional. We kind of pride ourselves in having footnotes to everything. Some footnote sources might be considered non-traditional. So the rate of change, if you're in a law school and you turn in a paper to the professor here, he probably has a certain expectation of how you fact check or cite sources, and that actually is challenging in the digital asset market because of the nature of its evolution and kind of what I might call a lack of structure. So all those factors came together, and we've now spent a little over a year working on it. So it's a subset of FSOC. About 60 agencies are actively involved. At the end of the day, all of them will opine on it. We've been in consultation with the White House, the National Economic Council, and the goal is to coordinate as an administration policy on the outcome. And we also have done a lot of outreach. If nothing else in other reports, we really value input from the market, be it academics, practitioners, investors, there's trade groups, there's advocacy groups, and so we've done a lot of outreach on this. Again, this is an area where doing outreach is a little more challenging than in places where traditional companies are organized, but that's also been very valuable. We've created a data library, we've created a shared resource of this information, and so I think the learning curve has gone way up among the Deputies Committee that's focused on this. So the categories of issues are, illicit finance, thinking about that as a topic, the evaluation of the infrastructure and vulnerability infrastructure, so kind of market structure, how markets are made, how the value is moved, how people exchange fiat currency for digital assets, the nature of the tokens, operations, governance, and mining. That's really unique to this area. If you take any other asset class, there's concepts there that are sort of unprecedented, so we've really studied those a lot. The nature of the intermediaries and their role with investors, particularly retail investors, has been a significant area of focus. And the international focus, as I said, we want to have a U.S.-grounded policy, but we've spent a lot of time at international venues, hearing their issues, hearing their concerns. There's obviously been papers published around the world on this. In terms of regulatory status, the elephant in the room is that no regulator has authority for the spot market for digital assets. So therefore, it is largely an ill-defined and unregulated entity. Also, the people that are largely transacting in it aren't regulated entities. The individuals working there don't have licenses. So really it's kind of like a blank piece of paper in terms of structure compared to how you might consider the securities industry or the commodities industry or the FX industry. So the SEC has made moves on it by defining the initial coin offering as an offering under certain circumstances. I know you heard from Bill Hinman earlier. The CFTC has identified many attributes of it being a commodity and has advocated for the creation at least of a couple futures contracts. At this point, they don't seem to have an agenda to radically expand the size of the number of future contracts. It's not their choice, it's really the exchanges, but they feel those two steps have been valuable. There also have been, unfortunately, a large number of market manipulation and fraud cases. Like any other new shiny object in the world, this has attracted a lot of people that sort of see an opportunity to make a quick buck and hustle. And obviously that valuation bubble that we had last fall was quite an attraction on that front. So unfortunately, that's been attracted to the industry, and the SEC and the CFTC both have taken a lot of actions. FinCEN, that's part of Treasury, has consistently, for years, since 2013, tried to treat exchangers as money exchanges and implement BSA, AML, anti-money laundering rules. They've done a great job with it. They have structure to that. They're in favor of sort of seeing that happen internationally. And finally, there was a report by the New York State Attorney General, and I wouldn't validate all of their findings or suggestions in it, but I thought was really interesting about it, it definitely talked about all the topics that need to be on the table. So topics like management of conflict of interest, how fees are set and disclosure, security, the nature of the fiduciary obligation between the exchange and the counterparties, order routing, suspension and outages. These are all topics that are just the nature of sort of transacting in a market. So I don't want to validate at all their findings as to being influencing us at all, but I do think if you take this subject, they're really worth talking about in terms of how do we see this towards a more mature state, similar to what you'd expect in a financial asset class. Just briefly on the international side, as I mentioned, the G7, the G20, the Financial Stability Board, the IMF, and most recently the UK Crypto Asset Task Force have all put out either directives or promulgation. I'm in domestic finance. We work closely with international affairs, and our goal is to have a unified U.S. agenda on this. The CFTC, the SEC are all on board with that. So I will promise you that we'll represent the U.S. interests in this very well. So I think to date, for whatever reason, the valuation bubble burst. It gives us probably a different perspective than if we were still dealing with that challenge. That's not to say we won't have wild swings in valuations and perhaps a reappreciation or new reorganization of the market. But I think that's taken some pressure off. I think the futures contract has definitely created price discovery in Bitcoin. I think the nature of institutions make it difficult for them to transact in this asset class. Things as custody and other elements are disconcerting to traditional institutional investors that actually have a regulatory framework they have to live with, be it the 40 Act or other things. So the futures contract gave them an institutional place to express their view on price, and probably that futures contract did have a role in moderating the price appreciation of Bitcoin. And finally, we really do applaud the SEC's focus on initial coin offerings. You know, one can debate how digital assets should be used. It's not too hard to see that the nature of capital raising perhaps got a little uncontrolled with the proliferation of offerings, and a real question would be raised as to how an investor could evaluate the quality and nature of those offerings. So again, offering no judgment whether they should or shouldn't be used as capital raising, but the SEC has laid out the principle that if it is like an offering and a capital raising, that it should be subject to some rules of registration and investor protections, particularly if retail investors in the United States are investing in it. On the anti-money laundering side, as I mentioned, FinCEN had a very developed approach to this in the U.S. They've been at it really deep into the last administration and have made a lot of advances, but there was not a very symmetrical approach to that around the world. So just recently, FATF, who's a president, which is now the Treasury official this year, Marshall Billingsley, that's the Financial Action Task Force, comprised of 37 countries, has adopted a directive to really change their glossary of defining wallets and exchanges, and advocates that member countries develop a consistent monitoring for anti-money laundering. It's not a prescriptive approach to it. Different countries might take different approaches, but 37 countries have now signed up for that. For people interested in this asset class, I really would sort of say that's sort of a non-negotiable component. You know, you just can't create something that's a conduit of illegal and illicit activities. No matter how good the technology is, if something really untoward happens, the whole thing is going to get shut down. So personally, I believe this is a very positive step, even though it might lead to certain implementation challenges, and probably with a regulatory environment focused on that will result in other benefits for market structure, transparency, and really key long-term characteristics for a successful market. So the next steps for us is to finish the staff analysis. The principals will then consider the risk and potential next step. I would surmise that a white paper or some kind of output will be appropriate, you know, possibly for public comment. We aren't anxious to have more legislation and regulation, but probably having parameters of what it should address if there is legislation is important. You know, the Hill doesn't report the administration of the regulators, so on any given day they can launch a new bill, and we'd like to make sure that it has the input of our learning and the financial regulators' insight, and also is competitive internationally. So we probably will have a legislative framework. So we're spending a lot of time on it. We certainly aren't rushing. We've been at it for a year. I've seen a lot of positive input from different aspects of the industry and influent thought leaders. The Digital Chamber of Commerce and the paper they put out was particularly, Token Alliance was particularly impressive. So there's a lot of really good organization going on. So in summary, I'm glad to take a few questions, but we're for the proper tailoring of regulation to sort of support the U.S. economy and eliminate undue burden. We want to encourage innovation in fintechs, but also in the traditional mature financial sector. And we want to encourage the development of all technologies, including blockchain, with the accompaniment of digital asset markets, which we think has some room for improvement and maturation, and we hope to lay out our framework for that sometime early in the next year. So thanks for your time. I'm glad to answer questions.
So I know that there are going to be lots of individuals who have lots of questions for you. I just wanted to lead off with two, and then just to open it up directly to the audience. Number one, just to make clear, when you look at the FSOC, getting, and this is a topic that we brought up with Sheila Bair, getting regulators to coordinate, even domestically across the U.S. federal government, is always a challenging operation. I know it must be something that's been at the top of your mind. What do you, I think this audience, we have a very interesting audience with venture capitalists, IMF individuals, regulators, and obviously lawyers. What do you think are the major impediments historically to that kind of coordination? Does fintech present a unique opportunity to operationalize a deeper coordination across our federal regulatory agencies?
Well, I think what's unique about fintech, as separate from, say, digital assets, is that our regulatory system is designed around certain types of institutions that have a charter, and generally there is a federal charter. So I think we have a really effective state regulation system for insurance, so there can be really effective state regulation. That's been developed over many, many decades, and there's an elaborate state system that's customized for insurance companies. They operate in different subsidiaries, so they operate in kind of the real world of sort of separate subsidiaries and pricing models and regulatory pricing models. But over time, as the biggest insurance companies have gotten very large, one state regulator is the lead prudential regulator. So the other states are largely looking at activities and pricings with interaction in their state with their consumers, and those interactions are through kind of a brick and mortar model. So I think what's challenging about fintech is that it has, it right now does not have really a clear federal charter such that if you're a national operator, there is not a clear path forward. But yet, because of the virtual nature of the companies, how they're delivered, in fact, the sort of the absence of offices, the state framework seems somewhat less applicable by the basic nature of how they're operating. And that's not to say states shouldn't regulate how you access consumers in those states, but it might be challenging for them to be a prudential regulator of such an entity. So I think that's probably the most unique challenge, is the federal versus state. Most of the other sectors, the fragmentation is well established as to what the purpose of regulation is. So if you're a bank, you might have the OCC as your primary regulator, but you also have FDIC because you have federally insured deposits. But the nature of how they work together and how the regulatory regime works together is established. This is sort of a blank piece of paper, and that tension between federal and state, I think, is one of the big differences. So it's not just coordinating with the federal regulators at FSOC, but really thinking about the state dimension that kind of keeps us up at night, and we think we need to get right.
Interesting. And I guess, secondly, the deflation of the crypto asset market certainly must reduce, as you've noticed and as you observed, a bit of the pressure and the concerns about systemic risk. But as this conference has proceeded throughout the course of the day, I'm increasingly led to ponder, is there a distinction between, say, the systemically important product and then, for lack of a better word, systemically important technologies? And fintech is a very interesting space because you kind of have the two bundled in one, depending on what kind of financial product you're talking about, let's say crypto asset. And so you have this potential where the financial product itself, who knows what's going to happen, to it, which are themselves either applications or protocols of an underlying technology. But the underlying technology itself can get incorporated into traditional banking infrastructures, maybe, traditional exchange infrastructures, maybe, payment systems, maybe. How do you go about the work of keeping your eye out, not just on the financial product, but really on, again, the technology itself from the standpoint of the government? Because I think that's going to be increasingly challenging as technology itself evolves quickly. And as a side note, not a U.S. regulator, but an international regulator who's well known had told me to the side that financial regulation is increasingly becoming data regulation. And when you combine that with technology, it just pushes regulators into a space that they're relatively unfamiliar with or new, and it's just an interesting activity, being a financial regulator and sitting in your chair. So, I mean, when you think about the technology and the challenges that poses, how do you go about the business of identifying and keeping your eye out for the risks, again, not just or associated with the product, but with the technology itself as it becomes either commoditized or infiltrates the traditional financial marketplace?
Well, again, we're for innovation, so really in more mature areas like use of the cloud or artificial intelligence, there continues to be challenges of how regulators look at those things. Does the cloud represent a higher degree of cyber risk? Is artificial intelligence, if you use it, do you perhaps violate concepts of fair lending or disparate impact that are concepts the CFPB has? So all these are questions that really need to be solved. So I consider that kind of the crypto's kind of the new thing. The core fintech are sort of established processes that have gotten to some stage of maturity, but still need increased level of maturity for regulation. So that's why in that report we kind of separated the two. One, we weren't finished with the digital asset work, so we weren't ready to publish on it. And two, those reports were Treasury recommendations. They weren't interagency, so we did sort of make an effort of triangulating with other regulators, but they were really our thoughts. We had the pen. So that's, so really the excluding digital assets from that report is just a matter of, if that report was a year from now, it would have been integrated. But I do think it's important to look at the nature of fintech, and these are fairly traditional, addressing fairly traditional financial services needs. It's sort of, in some ways, a disruptive marketing technique. It can be a disruptive credit analysis technique. Speed to market innovation can be quicker, but it's largely sort of overlapping with what we would all consider traditional financial services. Crypto, digital, blockchain technology is like a whole nother step. So I guess the first thing is to get the first phase right, and I think we put out a framework that we're moving forward on. I think on digital assets, just to talk about the bubble, I think the challenge of the bubble was that it, at its essence, and I don't mean to sound old-fashioned, if you take traditional investment analysis of cash flow and why a company is worth what it's worth, or credit capacity, or a pork belly is a pork belly and people do things with pork belly. Digital assets sort of defy traditional agreed techniques of traditional fundamental analysis and valuation analysis. So when that bubble started to unfold, it seemed to me to create a tremendous risk of investor protection, particularly retail investor protection, because the entities could be launched so readily. If you do an initial public offering of a stock, to get to a point where you can register with the SEC and get an underwriter to underwrite it, you have to have really substantial momentum in a business plan, certain set of procedures to be listed on an exchange. There's a lot of governance requirements. So, even to get to that phase is a huge undertaking, but for a digital asset, it could be just instant with a sort of 15 or 16-page white paper. So I thought that was what was, I'm not saying they're not worth that or not, so I'm not offering an opinion on it, but the rapid escalation made everyone believe that investing was a no-brainer. You'd be guaranteed to quadruple your money, put all the money on red 18 and off to the races, and that was creating a very unhealthy environment. So I think the consolidation is probably really healthy, And if at the margin there's some that are orphaned that actually are worthless and should have never been launched, that'll probably in the long run be a constructive development to have investors be more sophisticated, for intermediaries to think about how they approach customers, and have things like research and fundamental analysis catch up. So we're really positive about the technology, but the technology can be done between known parties, and it's another form of innovation. The idea of the network of blockchain between untrusted parties, which introduces the currency of the digital asset, is where I don't think you can separate the technology from the risk of the digital asset market, and we kind of need to get both of those right to achieve its potential. Now, what's interesting is technology, no one's talking about regulating technology. So it's really more how a regulated entity uses technology more than the fact that we're trying to regulate technology. Now, obviously, there's been a lot of concern in other aspects on the Hill of social media, search engines, and other things that have become a concern about privacy, use of personal information, involvement in the elections, you name it. So definitely those companies have drawn attention, but that's really kind of a whole separate matter from really what I consider to be financial services. Blockchain could support almost anything, and nothing about our work is sort of focused on regulating technology. It's more thinking if you have something that's a financial asset class, how should that market be structured?
Well, we will open this up, but I did want to, number one, for the purposes of the audience, to thank you. This is your second time here over at FinTech Week in the rain. And the Treasury Department, just for those of you in the audience, will be speaking in depth on issues of the cloud. We have the Comptroller of the Currency coming on Wednesday, and really the Treasury Department has been very engaged in its truest sense. So I want to thank you. Okay, questions from the audience? Yes, Jackie. And please identify yourself.
Hi, thank you very much for a great presentation. My name is Mike Satara, and I had just a kind of question. Today we collectively agreed we don't fully agree on our understanding of crypto assets, but I did want to ask a specific question on the US dollar globally, because there's been a lot of discussion about fiat currency and the motivations to use cryptocurrencies. The United States has a very active program globally using banknotes, US dollars, and I was just curious if there's an opportunity, just to discuss economic leadership to promote the US dollar, the call for a stable coin. The US dollar in most instances would represent what most people are looking for. So I guess my question is simply, is there any appetite or discussion around maybe looking towards a more global distribution of the US dollar in this format as opposed to allowing third parties to develop their own?
Well, I mean, I'll say a few things just generally. Obviously, one thing that we supported in our FinTech and Innovation Report is faster payments, right? So if you really look at what, say, Amazon has done in the retail business, they still have, a relatively small share of the market. But what they've done is they've totally changed expectation of the speed of service and the nature of access to the service, which puts competitive pressure on the entire retail industry. So we had a group of retailers in recently, and everyone from luxury brands to a FinTech startup has had to change their game to sort of meet the expectations of speed and convenience, sometimes even at a higher price, but to meet the expectation. So really in our FinTech report, we did say that the movement of payments in the traditional system has to be a focus. So the Federal Reserve had already put together a faster payment task force. As you know, there's the ACH or wire transfer system. The Fed separately does a tremendous amount of support for the US government for us to make payments. We make a lot of payments and also collect a lot of receivables, and they facilitate unique systems for that. And internationally, there's the SWIFT messaging system and CHIPS, which is run by the clearinghouse. So I guess I'm a slight skeptic that payments in the movement through crypto is necessary. It might be an approach that is viable, But the mature system has to really move payments better too. And consumers demand it, businesses demand it. There's already been a lot of innovation. The Fed recently has put out an RFI to say they're going to get comments and try to have some pipes that others can share. I think all of us can agree that if the pipes are laid, all different types of companies should share those pipes versus everyone getting their own unique mechanism. So I don't know whether digital assets are ultimately going to play a leading role in payments or not, but we're unambiguously for faster payments. I think the volatility of valuation is a challenge that speed is offset by value being on both ends. So if you're doing a conversion at a very high transaction cost on both ends, in and out of a fiat currency, no matter how fast it is, that would be a problem. So I know people have thought, well, how do you have a digital asset that's then linked to a specific currency, and would that be a solution? Again, I'm not opining on that one way or the other, but it's certainly worth talking about. So far in our discussions, the market regulators have been the leading voices because it's really kind of a market and a market product. The banking regulators have been less vocal, mainly because banks largely aren't involved in the product yet, either on behalf of customers or they're trading for their own account or custody. They're all, I think several are looking at it, which raises the question of if it has a dollar linkage, does it have some implication for banks, monetary policy, and other factors? But again, we don't really have views on any of this yet that are published. We're in the process of doing the work, but I do think all these are really good questions. And if linking to a fiat currency value, it does seem to me that if that's cash collateralized and there has to be dollars on deposits for every unit issued, it's not really increasing the money supply, but if there's a somewhat of an inefficiency to that. So I guess it's all a matter of how you structure that to make it viable.
Yes.
Bill Cunningham. So did I hear you say that no regulator has authority for Bitcoin spot market trading? Number one. And would that imply that, the SEC would not, be on firmly? I know I'm in a room full of lawyers, so I'm an economist, so I'm treading on thin ice here. But I was just curious about that statement. That's number one. Number two, opportunity zones and cryptocurrency. Have you all thought about the combination thereof? Could you create an opportunity zone coin, for example, in Southeast Washington, D.C., and use that to, capture that benefits from that program?
Sure. Well, my first comment about regulation is that every regulator has fundamental authorities, and those authorities are sort of grounded in either the statute that defines their authority or regulations that they've passed. And that's what I really am referring to is if you take the nature of what a digital asset is, it doesn't strictly fit the definition of a regulatory authority that any of the regulators naturally have. So the SEC has characterized their authority over offerings and said certain types of offerings should be registered. And the CFTC has said in some ways it is like a commodity, which gives them certain oversight. But just a digital asset sitting there on the floor, I think the elusive thing is how do you define what that is, and how do you not have that definition capture any other number of kind of assets or characteristics, from collecting wine to airline miles to other things. And I don't mean to be sort of glib, but as a lawyer, you can appreciate the challenge is how do you then describe this store of value and the nature of its ownership, and then map it to traditional things. So things like custody, there's a whole industry established around holding assets. So it used to be, I'm really old, there used to be paper assets, and Wall Street every day would deliver these assets against payment, and there were runners all over in southern Manhattan running around delivering these things. And slowly those things became digital in nature and electronically stored at clearing corps like the DTCC and changed on a ledger. But that whole body of law that defined the underlying asset, its transmission, and its custody, Bank of New York Mellon can hold that for a 40 Act mutual fund in an agreed set of procedures, so that's a holding. Whereas this type of asset, if you try to map it to custody and other things, the nature of its holdings, and you have your code, I have mine, we both have, it doesn't really fit the law. So it's not only just the nature of sort of how it's defined and sort of what you would call it, but also the related adjacent laws that are very important for commerce and markets aren't strictly applicable either. So it's just, I don't mean any negative way, but it's kind of a no man's land in that way of sort of how to think about it. And I think we've gone to great lengths not to prematurely regulate or restrict it. So we're still studying. But that's really what I meant by that, is that it doesn't fit naturally into the definition of a financial asset that has a body of law and then an adjacent set of procedures and law that allow for its movement and custody. On opportunity zones, we haven't thought about that. The Treasury has implemented now part of a tax bill which defines certain parts of the country, about 25% of the census tracts, as opportunity zones. And if you have a capital asset with a gain and you liquidate that and invest in one of those opportunity zones, there are substantial benefits, tax benefits. And so this is now being implemented in regulation as something that we think is very powerful to invest in these districts have been defined, which are generally low and moderate income areas. The governors and the states define them. It's roughly 25% of the census tracts. I've not heard any idea to, people keep talking about crypto cities and different elements of Walden and other things. I guess there's a crowd in Puerto Rico, which ironically suffers from not tremendous access to power, so hopefully they still don't mining down there. But they, I've not heard any connection of the opportunity zone tax concept with a crypto base, but there, as you research this, you do find people attempting to create new societies or subsets that use only crypto as one way of moving forward.
And just to jump in, because I think this is interesting, and precisely because the spot market for crypto assets that are deemed to be commodities are not really clearly, identifiably regulated, I'll just put it that way. Maybe it does produce more of an interest and opportunities for coordination as the Treasury Department tries to think that through. I know the CFTC has asked for more authority from Congress for that. And even when it comes to, I don't know about crypto assets and opportunity zones, but I have been, and it's been a lot of time traveling as many people in this room. And there are some interesting questions about international remittances that we'll be covering tomorrow over at the IMF for financial inclusion purposes.
So on a commodity, just to answer your question, so if you take something like a commodity that you can end up eating, there's a number of those, not only the definition of grades that you can, that define the commodity contract, the futures contract. The FDI would have rules that if you want to turn that into food that you sell in an American grocery store, there are all sorts of procedures you would have had to follow in the cultivation of that physical commodity for it to be legal, and all sorts of known penalties, tests, compliance procedures. So I just mean that these things that sound, if the CFTC says, I think it's a commodity, they certainly can say that, but what's missing is a series of connectivities between that and what I would call mature commodities that you can eat or make jewelry out of or do other things with. And so that's where that lack of definition, I'm not saying it's a good or bad thing, but it just generally does not fit a set of standards and agreed practices as a financial asset class or a commodity. And the challenge is that necessary? And if so, what's necessary? And what does that future look like? And that's really what we're studying. So we really have no preconceived notions other than it doesn't fit the exact. As a lawyer, would you agree with that concept? It's a bit of an elusive asset class if you try to describe its properties.
I would agree with that. My instinct as a law professor was to say, well, what do you think? But nonetheless, but my instinct as a lawyer says that is absolutely correct. Yes. Oh, I'm sorry.
Hi. Thank you for your speech. So I actually read the Fintech report, so it's my great pleasure to ask you this question. So my question is regarding regulatory sandbox. As you mentioned, the Treasury took the position that the U.S. should adopt some form of regulatory sandbox. So I also heard two arguments on the other side, mainly from the regulatory agency community. One is, although currently the U.S. has not adopted a regulatory sandbox, but that has not stifled the innovation in fintech sector in the U.S. So if you look at the number of fintech unicorns in the US. In terms of quality and number, they both far outnumber the rest of the world. And also, the second argument is that, so the last time we talked about deregulation, fintech regulatory sandbox was started from the UK, right, in 2015. So the last time the UK led this deregulatory initiative was with the FSA when they started this light touch approach to regulation. And that indeed led to London become a world leading financial capital. And then back then, this was before the financial crisis, and the US capital market saying, okay, New York is falling behind, so we also need to deregulate our financial institution. But then we all know what happened. The financial crisis happened, and then the UK FSA went out of business. And then, so I think now we're seeing something similar. I mean, the UK is leading this deregulatory initiative with this regulatory sandbox. So the US regulatory agency is saying, okay, so maybe the UK is not the best role model for the US. So I just wonder how you react to these two sort of counter arguments mainly from the regulatory agency perspective. Thank you.
Good. Well, I mean, first of all, the scale of the United States compared to the UK or Singapore is much larger. So first of all, we just have a much larger economy with a very diverse set of financial institutions. So relatively speaking, the UK has a fairly simple, unfragmented regulatory system. There's really one main financial regulator. They have some different departments. So it's just fundamentally easier for them to coordinate any type of innovation. It's not good or bad. It's just a simpler, less complex regulatory system and a dramatically smaller economy and country. You know, so part of our challenge is just scale. I guess what I would say, just and the other thing is I don't try to be too gloomy. I mean, the United States has had tons of innovation. So when you take all the leaders in social media and internet search and telecom and phones, I mean, we have a lot to be proud of. You know, Microsoft, Intel, et cetera. So I hate to be too gloomy that we don't innovate. You know, there's been tons of innovation. What's the case is that just how do you accelerate it? So really, I think the phenomena is that if you aren't a bank and you sort of adopt a new approach to any service, let's say lending, and you create a new credit model for making refinancing student loans, and you have a way of sourcing customers, processing the application, aggregating data, and making a credit decision. If you're not a bank, you can implement a certain number of those things on your own with a much lighter regulatory oversight than if you're a bank. Now, for that model to scale, probably they need to have banks that want to invest in their products. So eventually they'll be back to sort of dealing with the bank regulator, but each and every move is less subject to oversight, delay, and coordination. So I think what we were just mean by the regulatory sandbox is how do we create a spirit of encouraging that type of innovation that you see outside the regulatory system, inside the regulatory system. And the biggest problem is coordination, because if the OCC says something's fine, and then you end up with a violation with the CFPB, that's not too good. So a big chunk of the problem here is coordinating between different regulators, and also, you know, we're not talking about like rampant experimentation. These are, you know, gradations of changes. The problem is, I guess, in a concept is someone has a proprietary idea they want to experiment. You know, regulation's not so customized. You know, how does a regulator say it's okay for one company to do it, other companies don't know about it? If it then becomes approved, how do they change the rules for everybody? So the problem with regulation, it is one size fits all in a way, and that classes or institutions are regulated in a similar way. So whether it be guidance or a no action letter, eventually whatever the experiment is has to be transferred or translated to a whole class of institutions. So there's a lot of complexity to it, but you know, there's been a lot of great innovation. A lot of it's happened out of the banking system. A lot of those people are now partnering with banks. So there's really a lot to be proud of, and you know, there wouldn't be a big conference like this and so much growth and capital if there weren't a lot to be proud of. So we're not gloomy at all about it. It's just more how do you keep accelerating and building on those gains, and how do you have eliminate unlevel playing fields. You certainly can hear stories where someone's able to innovate, someone isn't. Now, I will say technology is a funny thing. Regulation isn't the only problem. If you have a traditional bricks and mortar branch system and a legacy financial system, you have a lot of people in that company that have a vested interest in not changing. So regulation sometimes is used as the boogeyman, but you can find examples of companies that have done incredible and bold innovations compared to their competitors, and you really see that regulation can be used as an excuse, and really inertia, people's protection of their jobs, investment in their legacy systems and their footprint, also are another powerful deterrent. So that's why another reason fintechs, I think, are able to innovate quicker is they don't have any legacy systems to integrate or footprint to rationalize. And so I really think regulation is only partially a reason why innovation may or may not occur at a certain pace.
Okay.
And it's powerful.
One last question.
Hello, my name is Sandra Macias. Thank you for speaking with us today. You spoke on the federal framework in general. I was wondering if you could discuss how states fit into the puzzle in general, particularly, for example, Wyoming is currently floating the bill for the crypto bank charter. How does that kind of fit into the broader framework that you were discussing earlier?
Well, we're not at all against state regulation, and state regulation probably plays an important role. I mean, you think of states as sort of, first of all, sort of having a say on, what products and services are offered to their citizens and how they protect their citizens. And so I think even with the OCC charter, no one's really talking about the states don't really have a role. I think where it's complicated is if the state is then the supervisor of the entity, how you have 50 different supervisors. So there's a concept of prudential standards of things like cyber risk, governance, and other factors that if you're subject to 50 different exams, it's just really hard to see if you're a nationwide operator how that will come together. So maybe there's some compromise where with a federal charter there's some agreement as to the state's rights to oversee the interactions with consumers, and there can be one global regulator. Maybe the states could agree that amongst themselves the host of the company would be the lead regulator, and the other states would simply do a role of regulating how the product's offered in their market. But you can see the dilemma. I've talked to a lot of companies where it's not so much that there's something wrong with the state. What's wrong with the state is there's 50 of them. So if you're operating nationally and you have overlapping exams and redundancies, there's just no way to rationalize and create a coherent environment. So I really am supportive of their efforts. They have a thing called Vision 2020 where they're trying to harmonize regulation themselves, coordinate examinations. But you might have a whole wave of state-chartered enterprises, just like you have state banks. And that might be progress, The main issue is if you try to operate on a multi-state basis, what happens then? So we're just for them all kind of thinking this through together and thinking, well, what's the right solution to promote a workable and safe environment? The other thing I do kind of resent is the state saying that we're for no regulation because of a federal charter. We don't mean that at all. I mean, having federal oversight does preempt you from certain state laws, for instance, like usury laws or other things, but it's not a move to having weak regulation. I could make the case it could be stronger regulation. So that argument has started, which is not at all what we're advocating. We don't connect a federal charter with weak or permissive regulation in any shape or form. And we think even with that charter, the states would have a viable role. So we really would like to see everyone come together on this, hopefully. And on the point of the crypto bank, I'm not familiar with that particular fact, but I could see people creating state charters, as they had with banks and other entities.
Great. So here's what's happening next. Number one, you all have been great in really true Washingtonian weather, number one. Number two, I know many of you have been wanting to network, and we will have drinks. After some remarks with Perianne Boring, I'm going to remove myself from the stage. Let us thank Mr. Phillips. So Perianne, he's going to give some final remarks, and then I know many of you have been itching to network, and there will be drinks in the main building.
So I will keep this quick because I don't want to get in the way of lawyers and their cocktails. Again, I'm Perry Ann Boring, the founder and president of the Chamber of Digital Commerce. We were established in July of 2014 here in Washington, D.C., and we have been following the blockchain policy environment from the earliest of days. Here we have seen the industry evolve rapidly. Like all new technologies, cryptocurrencies, and blockchain technology has been abused by bad actors. A number of high-profile scandals from Mt. Gox, Silk Road, the DAO hack, now ransomware, and others have really threatened the legitimacy of blockchain and cryptocurrency. Given these incidents, it's not surprising that we have seen many policymakers and law enforcement have anxiety over blockchain and this new technology. And this is one of the key reasons why we established the Chamber of Digital Commerce 4.5 years ago, to be a resource for both the industry and government, to help address these types of concerns, to provide a platform for the public and the private sectors to work together, to weed out bad actors, to establish regulatory frameworks that address nefarious activity, but without stifling or hindering innovation, and to ensure the potential promise of blockchain is widely understood and adopted. I've been so proud of our members who have made countless trips to Washington, D.C. to volunteer their time, to educate people in this town about cryptocurrencies, about blockchain, to share what they are building, the technology advancements their companies are making, and why this is important. As someone who works with innovators in the blockchain space every day, I can tell you that this industry wants to work with government. We want to have responsible and safe markets. The industry wants to be compliant, and they've invested significant resources to be so, despite what sometimes the media will make them out to be. Our work at the Chamber, through having dedicated resources for blockchain in our nation's capital, has made such a difference. Just to walk us through history, 5 years ago, when we were just getting started, there were only a handful of people in this town who had any idea what blockchain was. For the ones that did, pretty much the only thing that they did know is that there were people buying illegal drugs online with Bitcoin. We had a senator who called for a ban on Bitcoin. There were agencies running from the FTC to the SEC that were issuing warnings about how dangerous this technology is. And rather than focusing on the big picture of what this could become, they were putting a magnifying glass on all the nefarious activity. In just a few short years, the dialogue in Washington, D.C. has been a complete 180, and today is a huge testament to that. We now have a congressional blockchain caucus with 18 members of Congress. So we used to have members calling for a ban on Bitcoin. Now we have a caucus. That's a pretty big difference. We have blockchain champions throughout government, from CFTC Chairman John Carlo, who has said that blockchain is in the national interest of the United States of America. We've also seen SEC Commissioner Hester Peirce, who's called for the SEC to provide innovators with greater clarity and certainty around their interactions with the agency. And we also have huge champions and the co-chairs of the Congressional Blockchain Caucus, just to name two of them, David Schweikert and Tom Emmer, who have introduced resolutions representing and recognizing the importance of blockchain and cryptocurrency. It has been so rewarding just to see all the people throughout this town to make public stances on promoting and supporting blockchain. And in the words of Craig Phillips, who said there's a lot of potential there. But this is not enough. The industry still faces a number of hurdles to adoption, regulatory uncertainty being at the top of our list at the Chamber of Digital Commerce. Here, the United States is at a bit of a disadvantage when it comes to financial regulation because we have a very fragmented approach to financial oversight. There's no less than 12 regulatory agencies that have jurisdiction over some part of blockchain-based applications. For example, the SEC has called ICOs securities. The SEC has labeled digital tokens as commodities. FinCEN is regulating Bitcoin and other convertible virtual currencies as currency, and the IRS refers to virtual currencies as property. We don't blame the regulators for this, though. We believe that they're doing their jobs of enforcing the laws that they are responsible for. The issue is really that we don't have a plan. There is no national plan for blockchain in the United States, and without a plan, every agency is just marching to their own drum. There's no coordinated effort. This is why, and additionally, there's all limited resources in each of these agencies. So it's very difficult for them to address anything that's out of their main priority. So if there was a coordinated plan, we could accomplish their main goals of oversight, but also have a way to address blockchain technology. Today, the Chamber of Digital Commerce is calling on the U.S. government to establish a national plan for blockchain. First and foremost, the plan would recognize blockchain as an important technology that needs to be protected from muddled regulatory oversight. Next, the plan would harmonize regulation to create an environment that allows blockchain technology to grow and to develop. And finally, government agencies would work with innovators and respond to their needs so that the United States can drive innovation further. The U.S. has a long-standing history of being at the forefront of innovation. Without a national plan for how we're going to embrace blockchain, we're at risk of falling behind other nations that desperately want to advance their stance on the world stage. And to reiterate what Mr. Phillips just said, he said it's important that we get this right for the American workforce. Mr. Phillips also referenced the work of the Token Alliance, which is an initiative that we sponsor at the Chamber of Digital Commerce. We launched this initiative over a year ago to address all the activity we were seeing around ICOs. We've seen anywhere from $5 to $7 billion of financing through ICOs just in the past 12 to 24 months. Some of that activity has been good, some of it has been not very good at all. But as a way to delineate the good from the bad, the Token Alliance has brought together over 400 stakeholders in the token space to issue guidelines for what responsible token platform and token trading platforms look like. And we are proud that we have issued this report on GitHub. It's open for anyone to benefit from, including businesses who want to follow our guidelines and our best practices, and governments and self-regulatory organizations that are looking for new ways of governance for blockchain technology. To learn more about the Token Alliance, the Chamber of Digital Commerce, and our other initiatives, just visit our website at digitalchamber.org. I'd also like to invite all you back to DC in March to attend the DC Blockchain Summit, which will also be held at Georgetown. Would also like to thank Chris Brummer from Georgetown for hosting Georgetown Fintech Week. What a great first day. Chris, thank you for all your support and all your leadership in making this the event that it has been. Let's give Chris a round of applause.
Okay, so drinks. Ho-Tung Building. One last thing. So every day of FinTech Week, when we, Christine, Washington, and Jackie, we go through our list as to registrants, and there's only about maybe a 35% overlap of the days, which means that every day there are new masses going to each day. And so tomorrow will be more of an international day over at the IMF headquarters. And then Wednesday, as you'll see in your schedules, we literally have Chairman Giancarlo wants to make a big announcement, which will be very interesting. And we also have the Comptroller of the Currency and our FinTech Shark Tank with a bunch of VC capital folks. So, and then we'll have also a series of events on the Hill. So this is just a very long-winded way of saying we hope to see you back. There will be different people every day. We can pretty much guarantee it based off of our registrations. And if they are going to come in this weather, then they'll be here throughout the week. So thank you so much. Christine and Jackie will be walking you to the free liquor across the street, which is what everybody really needs right now. Okay, great. It's in the Ho-Tung Building. Just walk across the street.